Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday. It's October 31st. It's Halloween. Oh, my daughter's so happy she gets to go trick-or-treating today. My birthday was on Saturday. I had a wonderful birthday. I want to thank each and every one of you for the great, wonderful birthday wishes. I think I got 500 happy birthdays over the weekend. So it was a really, really nice way to celebrate my 52nd birthday. Now, let's get into today's agenda. We've got a lot of stuff to talk about today. So first of all, it's the last day of the month. November is setting up to be a very interesting month. And I want to show you what's going on. First of all, we've got the FOMC announcement. We've got a big report on interest rates this week. And the odds are very, very strong that we're going to go up another 0.75 higher. That's baked into the market. The odds of that about 85 to 95% at this point. And then in the December rate hike, we're looking to go 0.50. That's also baked in at about a 50%. And I'll tell you how that goes later today or tomorrow. Now, this week, we've got the ISM Manufacturing Index. That'll be very important. But obviously, the biggest report is going to be the Fed. You've got international trades and goods and services, employment, factory, but the Fed is going to be running the show. All eyes this week will be on the bond market. Now, as you can see here, with the rally that we've had in the stock market, let me just kind of go through the Dow. And it's important for me to show you this. The Dow's now above the 200-day moving average, barely. RSI levels are grossly overbought, and I think it's going to cool off. And also, I believe the bond market has been helping it out, and I think it's now getting ready to revert back lower. I'm not seeing too much upside. So don't be surprised if you saw the market cooling off. Another major factor that's telling me that the market may be getting, not just yet, but getting there, starting to get there, is the number of stocks making 20-day highs versus 20-day breakdowns. When this number gets above 400 to the upside, it's maybe 3-4 days away from peaking out, if that. Because whenever you have this over 400, 500, it's just too much versus 25. The ratio is getting way out there, and it's finally starting to look close to what the stock market looked around here. Let me show you this level. I want to kind of give you an idea of where we're at right now. So the last time the stock market saw the kind of momentum levels was right around here. And then we peaked out like 2-3 days later. So again, I'm just kind of giving you heads up that momentum levels are getting a little bit upside. Remember, I told you, I'd warn you, they're not there quite yet, but maybe another day or maybe, it doesn't go well above that. Maybe another 100, another 150, maybe another day or two, but not expecting too much more upside, which is why I've been increasingly adding short positions like GE, like Six Flags Magic Mountain, like Marriott. So a lot of, plus with China talking about COVID again, I don't think consumer stocks are going to do as well. Also, we're past the summer travel season. Christmas holidays, I don't think are going to be that crazy right now because of the inflationary pressure. So I think that's where the stability is. So keep your eye on the bond market, and if it starts to fold, there's a good chance we'll see the stock market fold. Volatility is at the 200-day moving average, as I predicted. We're still short VIX options, and I want to see how they react over the next couple of days. I may get rid of those positions because I think the market is getting ready to cool off a little bit and come down. I think what we're seeing is a little too much too fast. I mean, look at this Dow. It's just been going up. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, like 2 weeks straight. It's a little too much. It's at the 200-day moving average. Every time we hit the 200-day moving average, it tends to huff and puff and then cool off. We got the Fed going ape, you know what, with the interest rates. I think this is going to peak out in the short term, and I think we're going to start seeing some reversion to the downside. In terms of the SPY, similar, the SPY can go a little bit more. It's not as overbought as the Dow, so we do have some more upside. And the Russell 2000, let me look at the QQQ first. Yeah, the QQQ barely moved. So what I'm really talking about is more focused on the Dow Jones. The blue chips look like they're just running too far away. Let's look at the small caps. Yeah, the small caps. Similarly with the small caps, they look like they're getting a little overbought. Remember, we're still below the 200-day moving average, even though the Dow is above it right now. Technically, I mean, I wouldn't really call this too much above. And with this RSI level, this is not sustainable over time. So be prepared to see a little downside on blue chips and a little bit of stability in technology, or not as much downside in technology, because technology hasn't really gone up too much. It's not really overbought. So we could go a little bit down, but not too much. My eyes are telling me that we're going to see less downside in the tech stocks that have already seen a lot of downside and a lot of earnings, and we're going to start seeing more negative exposure in the blue chip broad market. Volatility levels, as I mentioned, are right at the 200-day moving average, and I think we can go down a little bit more. But again, keep your eye on the bond market. If the bond market starts going south again, it can put some pressure on the stock market. Now, let's talk about global economy, and we'll move into the nitty-gritty from there. So, world stock market was mixed on Monday ahead of what is expected to be the Federal Reserve's decision this week to raise rates again. And investors hope the central banks will scale back their plans, but it's 0.75 is priced in by over 90%. Wall Street ended last week higher after Apple and other big companies like Intel reported strong profits. Some stocks like Amazon just fell. Google didn't do well, Amazon, but I think we're bottoming out in the tech right now as we speak, because we didn't really respond nearly as much as we did on the Dow. I mean, look at the reaction on the Dow versus the QQQ. So we have a lot more stability, I think, right now in the tech in the short term than we have in the blue chip stocks. Let me go back into this. The Fed is widely expected at this week's meeting to announce another rate hike of 0.75, 3 times its usual margin. Investors are looking for signs that officials are satisfied that earlier increases imposed to cool inflation that's near a 4-decade high are working. Remember, all this stuff we'll find out in hindsight. It takes several months to feel it. It's all hindsight, which is why I think they're making a big mistake. I think they should go slower, because I think a lot of what they're expecting is already being priced into the market. U.S. government data showed Friday consumer prices rose 6.2% over a year earlier, the same as the previous month's rate. That's not happiness. And remember, what about inflation? Consumer price rose 6.2%. What about 8.2% inflation? Core inflation, which removes the food and energy, the volatility, that's what the Fed looks at, accelerated to 5.1% from August 4.9%. And other Fed officials have said they're ready to keep interest rates elevated until they are sure inflation is extinguished. The problem is, by the time this hits Wall Street, it's already worked into the market, and what they're looking at is a delay. They were too late to react when they didn't do anything, and they're too late to react right now. They would make the worst traders. Friday data showed wage increase for American workers were in line with expectations. That'll take a little bit heat off of Powell. Powell has cited wages as one measure that the Fed is watching. It's not a normal recession because wages, employment numbers are solid. Looking at individual sectors, which I definitely want to do right now. Let me take a look here. Let's take a look here. Where are my sectors? I've got so many studies here, I can barely, there we go, remember where my sectors are. So if you look at this on a strength basis, you've got energy, industrial, and financial going up is not typical during a recession. During inflationary period, yes, but not during a recession. And industrial is moving higher, and I told you that it would. Metal stocks had really good earnings. Healthcare is looking good. Consumer staples looking good. If I were you, I would focus on these sectors: energy, industrial, financial, healthcare, consumer staples, and maybe even material. But technology, I don't know about utilities. That's a red. For some reason, it's deflated. I think utilities is actually going to be coming up. It's very defensive. But consumer discretionary, communication, real estate, technology, those sectors I would be very, very cautious off right now. Very, very cautious off right now. Now, looking at them visually, as you can see here, energy looks like it's a little overbought right now. Industrial stocks look like they're rocking and rolling till you see a little resistance there at the 96 area. Financial stocks look like they're rolling too. Let's see what happens at the 34.90 level. Healthcare has already taken out that nasty peaky resistance, and it's already headed all the way high. I told you it would several months ago. Utilities are starting to look good, but we have this resistance level here at 69. Technology looks like it's took out its resistance, which is great. Materials looking good. Consumer staples are looking solid. Everything is looking good except communication services is looking awful. Consumer discretionary looks like it's building a base, and real estate looking like it's rally. Notice that a lot of these sectors, and this is what you guys pay me for, or at least this is why you watch your videos, these videos. Notice volatility is expanding. Volatility expanding is a very, very strong sign that the trend is starting to get a little overheated. So notice the bar, the size of this bar in comparison to these bars. That's a very, very powerful signal. Very, very powerful signal. And not to mention the fact that you've got 20-day breakouts near the 400 area and 20-day breakouts near the 25. That means the sizzle is starting to fizzle out. My suggestion to you guys, my suggestion to you guys right now would be to focus on some ETFs. ETFs usually prolong the trend ahead of stocks. Some ETFs that you may want to look at are energy ETFs, industrial ETFs, maybe XLI, which is the industrial sector. Tech right now is very, 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 very risky. As far as data, keep your eye on bond market and keep your eye on volatility. Volatility in bonds are really going to give us a really good picture of where we stand. If we break below the 200-day moving average, then we're looking good. Also remember something else. Not all sectors and indices are moving together right now. Techs are a little overdone and they're basing. Dow stocks are just overextended. So you may see some squirreliness in the market over the next few days. Let's keep low exposure. Let's be diversified long and short, and let's keep our fire powder a little dry, okay? Because we got a lot of stuff going on, and I want to take advantage of it. Now, before I let you go, before I set you off for your week of fun in the sun, if you're in Florida at least, Joy of the Trades, Jeff Zananeri, he's uncovered something that could literally, fundamentally change the way you invest in the coming months. He believes it could trigger the biggest market ever in 2022, the biggest market event in 2022, and could very well trigger a massive shift in a $54 trillion market. Yes. Now, Jeff wants to make sure every investor is prepared for what's to come, because if you're not, you could miss out on a critical opportunity. That's why he's put together a very special live event for November 1st. That's tomorrow at 1 p.m. Eastern Time. And no, it doesn't cost a thing to attend. Follow the link below. Jeff is really good at this stuff. He's great at connecting the dots with global economy. And right now, we need that more than ever. I mean that. We need that more than ever. Follow the link below. Check out what Jeff's got in store for you. And I'll talk to you later. If you like this video, subscribe to this channel, comment below in the YouTube channel, and I will respond. Bye, guys. Have a great day. And thank you for making my birthday very, very special once again. Bye.